Study objective 5 is about accrual adjusting entries. And in this study objective, we talk about accrued revenues and accrued expenses. Accrued revenues is when, remember, when we're doing work, but we haven't billed for it yet. Okay, so no revenue's been recorded. We haven't gotten any payments yet, so nothing would have happened. No cash has been received, so nothing would have happened to cause us to record any revenue. So we've got to make an adjusting entry to record revenue. So what we do then is, we notice that this person is doing some work and they haven't billed the services yet as of October 31st, but they've got a fee that is due. So they need to record some revenue even though the cash isn't going to be received until the next month. So in these types of adjusting entries, we're going to increase an asset, accounts receivable, and credit revenue to show that we've got the earned revenue, but we're not getting any cash yet. So the accounts receivable, it doesn't say it here, but the accounts receivable is what is going to get debited to show that we're owed money even though we haven't yet billed for it. So the example put out in this part of the text right here talks about the amount of earned money, and here you see the journal entry that would be required for the adjusting entry. Increase the receivable, increase revenue. That gets this revenue recorded in the period that we earned the money, according to the revenue recognition principle. Accrued expenses, same idea, but kind of in reverse. These are costs that we're incurring that we haven't paid for yet. Okay, so we've got no basis for having recorded any expense as of yet, but we're incurring a cost. Like we're using utilities is a good example. Interest, taxes, salaries, all of these are also common examples of where you might have to accrue expenses. In this scenario, in this type of adjusting entry, we will be debiting expenses because we're incurring the expense, and we're going to credit a liability because even though we don't have a bill yet, we know that we're going to have to pay these amounts eventually. So accrued interest, this gets at how to calculate interest on a note or a loan you might have. So you figure out an amount of interest that you owe for a period of time, and then you record the adjusting entry right here. Debit expense, credit liability, just like I showed you up above. Accrued salaries, same kind of thing. You have paydays that vary. Maybe say every 2 weeks, and then there are some days that go by where people are working, but the next payday isn't until the next accounting period. So at the end of, let's say, October, you can see a payday here is the 26th, but there's 3 more days that people work in October with no payday. So these wages that were earned on this day, they have to be recorded as wages expense in October because that's when the people worked. So we need a way to record an adjusting entry to get those expenses included in October. So you calculate the amount that is due, that is earned, for those 3 days, and you debit expenses, credit payable. So it's the same idea as interest expense was. The trick here might be calculating the amount of the wages. In this example, they tell you $400 a day is the amount earned. There were 3 days right here worked, so that's $1,200 in earned wages that are not payable until next month. You'll see then next month, as soon as the next payday comes, you will reduce your payable by this $1,200 because you'll be paying off that payable related to the prior month. You'll be incurring some more expenses because people worked more. If you go back up to this calendar, people worked all these days in early November. Okay, so there's more payroll expense that's been recorded. That has to be recorded, and then the full amount of cash for the full 2-week period gets paid or credited to cash. And here's the examples. There's a summary here of all the relationships, debits and credits, toward the end of the study objective.